A very good morning to all of you. Mr. Anant Nageshwaran, Mr. Kotak, Madam Madhabi Buch, dear participants, good morning. A pleasure to have you with us this morning, and I welcome you to the 5th SEBI-NISM Research Conference, a two-day conference which focuses on exploring the many facets of our conference theme, Sustained Capital Formation, the way forward. The conference aims at providing a platform for academia, industry interface, helping exchange of knowledge, ideas, best practices, and to catalyze innovation. To begin with, I'd like to mention that capital formation stands as a cornerstone for the nation's economic growth and development. The good part is we have capital in good measure, whether it is through the traditional channels, but all this needs to be raised transparently and then channelized for sustainable development and growth. The dynamics of capital formation have profound implications, especially for India. To meet India's aim of becoming a developed economy, investment in infrastructure will be key. Substantive development will require investment in all forms of infrastructure: physical, digital, social, climate. The budget estimates for 24-25, the capital outlay for infrastructure is expected to increase by 11% to 11 lakh crores, which this amounts to 3.4% of GDP. Going forward, India will also need to spend more on infrastructure, which according to estimates stands at 8 to 9% of GDP. It's clear that the demand for funds far exceeds supply. With government funding nearly 70% of infra projects, it's expected that going forward, private capital and investment needs to contribute a higher proportion of the total funding that is needed. This is easier said than done. In order for private investments to flow, we need more depth in bond markets, including municipal bonds and infrastructure investment trusts and REITs to supplement the equity markets, which we think is very well developed. We also think going forward, more and more population of the nation will move to urban areas. It's imperative that the municipal bond market grows. We have seen great traction in the InvIT and the REITs market. Another source of funding will have to come from the financialization of household savings. As per the statistics published by RBI on financial assets and liabilities of households, the stock of financial assets of households forms 103% of GDP at the end of March 23, which is roughly about 280 lakh crores. But the challenge is, how do you channelize all this? Because a lot of it is in the form of gold, real estate, and other assets. Of the total financial assets, bank deposits were the preferred choice of households with 45.2% share. Mutual funds form only 8.4% of the total financial assets, though that has also been doubling very, very fast. On an average, financial assets have been growing by 12% year on year for the past 3 financial years. Of this, investments in equity and mutual funds forms only 4%, while bank deposits take away 40%. It's clear that the potential investment capacity is already present in the financial system. What we need are the right methods and means to take this forward. The rise of retail investors post-March 20 is a story that has been iterated multiple times. I will take a few moments to run through the latest figures. The number of unique mutual fund investors as of March 24 stood at 4.3 crores, almost double what we had in March 20. The total assets under management also have been growing very fast. In 2013, we were at 8 lakhs. In March, we have crossed 54 lakh crores. The same is naturally reflected in the growth in total demat accounts. Presently, the total number of demat accounts stands at close to 15 crores, which increased 3.7 times from March 2020. Nearly half of these were added in Tier 2 cities and beyond. During the course of this conference, we will touch upon topics that will shed light on challenges before us in more detail. We are delighted and very happy that the conference begins with an address by Mr. V. Anant Nageshwaran, Chief Economic Advisor to the Government of India, on his thoughts, and that will be followed by an address by Chairperson SEBI, Ms. Madhabi Buch, followed by Mr. Uday Kotak with his keynote address. The panel discussions will take you through the next big ideas of capital formation, deliberation on infrastructure financing, and how do we move from being savers to investors. NISM, as you all know, was formed in 2006 with the objective of building capacity of various stakeholders of the Indian securities market so that we have an efficient and robust securities market in place. The purpose of NISM has been changed recently. I'd like you to just listen to this, that to develop NISM as a premier institution recognized globally for capacity building. Capacity building is very important in the securities market ecosystem with the objective of enhancing quality, compliance, efficiency, and effectiveness of the participants in the market. This would be achieved through skill development, professional training, and certification. To achieve this purpose, NISM has been carrying out a wide range of capacity building activities for professionals in the securities market with an objective to disseminate knowledge through technology-driven initiatives like e-learning programs, webinars, hybrid programs, etc. NISM also considers the importance of industry collaboration. Since inception, the focus of NISM has been to engage with industry partners to understand their training and skilling requirements, enabling it to jointly develop programs and certifications that directly address their needs. NISM has been reaching out to market infrastructure institutions like NSE, BSE, and other intermediaries so that professionals are well trained. These initiatives underscore our commitment in strengthening our ties with industry and facilitating innovation for a more collaborative future. By bridging the gap between theory and practice, this conference will enable collaborations so that we have more meaningful insights with outcomes that are relevant, useful, and that can be applied to the real world in the securities market. Finally, I conclude my address with few words from the book, Psychology of Money. Growth is driven by compounding, which always takes time. This holds true for developments, changes, and improvements that always compound over a period of time. I once again welcome you all, researchers, market participants, industry experts, and my colleagues from SEBI, NISM, to this year's conference. I hope we get wonderful insights from this conference that will guide us in policy formation and designing programs and certifications that address the needs of market participants.
So pleasant to hear you today. Shri V. Anant Nageshwaran is the chief guest today, and we are excited to hear some words from him. Instead of his tiring busy schedule, he agreed to be with us today. We are grateful to him for the same. Being appointed Chief Economic Advisor in January 2022, Dr. Nageshwaran is a writer, author, teacher, and consultant. He has co-authored 4 books. He has taught at several business schools and institutes of management in India and in Singapore. He was the Dean of the IFMR Graduate School of Business and a distinguished visiting professor of economics at Kriya University. He was one of the founders of Avishkar Venture Capital Fund and the Takshila Institution. He was a part-time member of the Economic Advisory Council to Prime Minister from 2019 to 2021. With that, I invite Mr. Nageshwaran to kindly address our distinguished audience. Welcome, sir.
Ashwini Bhatia, Director at NISM, Ms. Madhabi Puri Buch, Chairperson of SEBI, Mr. Uday Kotak, Founder Director of Kotak Mahindra Bank, Sir Peter Patnaik, Chief Economist NSE, Mr. Anand Narayan, SEBI full-time member, other distinguished full-time members of SEBI, ladies and gentlemen, it would have been my absolute pleasure to be there in person, be with you and share my thoughts. However, one thing I have learned in the last 2 years is that it has made me very philosophical. In other words, the extent of uncertainty that we face in terms of even having control and influence your day-to-day schedule is so light that one simply has to go with the flow, and nothing is certain until it is actually completed, not even when it begins. So this particular address which I would have loved to deliver in person was pretty much a certainty until about 36 hours ago, and then certain developments happened which required my presence unavoidably here in Delhi, and therefore I am delivering this lecture virtually, and my grateful thanks to SEBI and NISM for organizing this virtual interaction on my part, and my apologies to all of you for not being there. When Deepali was making the initial announcement about the focus of this conference, and I have spoken at this conference, if I am not mistaken, in 2020, I think a few weeks before COVID enforced a 2-year moratorium on REITs in the world. She said sustainable finance the way forward, and that made me shudder involuntarily, because some of these words like sustainable, green, climate, environmental have all been overused to the extent that many of them have lost their meaning. They have become nice scaffolding or convenient packaging for industries, policymakers, regulators, financiers, and everybody to float whatever else they do in this language. And that fad and fashion, therefore, is not the subject of this research conference. According to the complete schedule I got, it is sustained capital formation, the way forward, which I like. And I was also very happy to hear from Director NISM, Mr. Bhatia, that apart from taking out the statistics on number of investors in the market, number of demat accounts, assets under management, etc. Towards the end of his remarks, he also cited one of my favorite authors, Morgan Housel, from The Psychology of Money. And he did speak about the power of compounding, which takes time. And that is the key consideration that all of us attending this conference have to take away with us. Capital formation also takes time. And one of the most important ingredient of capital formation, I will come to the non-economic ingredients later. But the economic ingredient of capital formation is, of course, economic growth. And there is a mutually dependent and symbiotic relationship between capital formation and economic growth. Capital formation is required to generate economic growth, and economic growth in turn generates the income and savings to facilitate capital formation. That is why the economy is a system of mutual dependencies. That is why when an economy goes into a funk, you need exogenous shocks to lift it out of the funk, which normally comes from fiscal stimulus, because the fiscal authorities, given their ability to tax, or the monetary authorities, given their ability to print money, or external demand, or the factors that do not necessarily fall within this closed loop system. And these are considered exogenous factors that can once in a while be applied to lift economies out of downturns. Otherwise, capital formation and economic growth are naturally codependent. And in this regard, we are all very happy to know that our economy is poised to grow at more than 7% for 3 consecutive years. And with some very good luck and reasonable assumptions, we might do so in FY25 as well. That would be 4 consecutive years after COVID. Not too many economies around the world have managed to achieve this feat. It is as important for us to learn from our successes as it is important to learn from failures. So how have we been able to get to these possibly 4 consecutive years of 7+? And the answer is that we did things prudently in a calibrated manner and did not get carried away. I have deliberately chosen words which apply very much to capital markets as well. Not getting carried away, doing things prudently, and knowing your strengths and limitations. And I'm talking precisely about the fiscal and monetary stimulus that were applied to the economic downturn that followed the COVID pandemic onset. Because the fiscal and monetary stimulus were measured, calibrated, and finite, it was possible for them to be pulled back. Monetary policy pulled back earlier, and fiscal policy is now pulling back very actively, as is evident in the interim budget presented for FY25, and creating fiscal space in good times, withdrawing the fiscal accommodation that was needed for 2 years or 3 years after the onset of the pandemic. So, in other words, it is important to know one's strengths and limitations and not get carried away by conventional wisdom and groupthink, which at that point, and even I myself have to admit that I wrote in an op-ed in Mint that the government of India should use the opportunity to kickstart growth with a large fiscal stimulus, because we already were getting into an economic downturn in 2019-20 as well. And I'm glad that the policymakers in North Block, the building that I currently am part of, did not heed such advice, including from me, and stuck to their chosen path of prudence, targeted and effective fiscal intervention. In other words, one of the important things to sustain capital formation in the economy and the way forward is to not fall prey to conventional wisdom and groupthink. So that is, apart from economic growth, apart from responsible fiscal and monetary policy making, the most important considerations I want to mention here are behavioral factors in my opening remarks. Mr. Bhatia spoke about the new mission of NISM, and he spoke about skill and capacity building in among various players in the capital market. I think conferences such as this have to also focus on the behavioral dimensions that will sustain capital formation. And I'm coming to that. The reason why we in India have so far, and that is why I like the use of the word sustained capital formation as the theme of the conference. In general, sustaining a certain activity or performance over long periods has been rarer in our country. It has been more the exception than the norm. I'm talking at the macro level, and I'm aware that among the audience, among the speakers, we have Mr. Uday Kotak, who has successfully built a sustained, successful business. And there are many such excellent corporate entities which have sustained performance and made a name for themselves and earned well-deserved reputation. But I'm talking in the macro sense. In general, sustaining performance over long periods has been elusive. We have had short bursts of economic growth for 8-9% over 3 years or 4 years, and soon thereafter we run into the brick wall of imbalances, overheating. And naturally, in its wake follows high trade deficits, higher inflation, overvalued exchange rate, non-performing assets in the banking system, etc. And the cycle and the clock is set back to zero again. So in other words, we have always had this problem of running out of breath and running out of steam after a few years. And just to put it in perspective, China's economy grew at an average of 9 to 10% for nearly 30 years. And even if we discount some of those growth rates as inferior in quality towards the end of this 30-year period, for the large portion of the 30 years, the quality of growth was very good. And there were many things that they did rightly, such as investing in scale, and also in the initial spurt of reforms post 1979, there was a lot of emphasis on bottom-up growth, town and village enterprises, agricultural productivity, etc. So it's important to remember that for us to be able to sustain capital formation, we need sustained growth without succumbing to the short-term economic cycle, which in turn arises out of our mindsets, and that is what I am laying the foundation for in my remarks. This time around, we have some hopeful and promising signs that we can indeed sustain the capital formation. The most important and visible symbol of this hope for sustained capital formation is the physical infrastructure that has been created over the last 8-9 years. I have not been tired of mentioning this in my remarks in various forums. Example illustrates this very clearly. In the last 1 decade, or even less than that, we have doubled that number. And you can look at power capacity addition, electrified railway lines, national highways built, number of educational institutions created, etc. All of them attest to the fact that India's supply side limitations have been considerably addressed, and of course that is not the end of the road. It is a journey, because an economy that is graduating from poverty to underdeveloped to lower middle income status towards middle income and upper income status will continue to require the creation of infrastructure. But more important thing is the mindset shifted to realizing, accepting and acting on the importance of supply side constraints being relieved, which is what we see manifest in the physical achievements of the infrastructure that have been created. The second reason to be hopeful about is, of course, the creation of the digital infrastructure. And it is not just about being able to undertake transactions for the small sums of rupees electronically without carrying a wallet. More importantly, it is a step forward. It is a pathway to financial inclusion, to formalization and market access. Not financial market access, that is important, that is why I said financial inclusion, but market access in a broader sense for one's products and services without having such a large presence, physical presence. Even small businesses today can aspire to tap the local markets in the country and possibly even global markets with their presence in the digital marketplace. That is a very important development. And the third ingredient for us to be hopeful about sustained growth and sustained capital formation is the fact that our corporates and our financial institutions have come out of their balance sheet troubles and they are in the pink of health. And they are therefore having the risk appetite and the capacity to be able to borrow and lend respectively. These are the three important physical signs or indicators that give us optimism and hope about sustaining capital formation. But I spoke earlier in my remarks about the importance of behavioral dimension, and one thing I mentioned was the willingness and the ability to defy conventional wisdom, carrying the courage of your conviction, to be able to do things that you believe is right within your capabilities and also which accommodates and recognizes one's limitations. And not only investors in Indian stock market today, but even bankers, financiers, non-banking financiers and Indian corporate sector would do well to remember this on a daily basis and practice, because the biggest risk to India's sustained capital formation and sustained economic growth is not even in these physical attributes, but in our short-termism. And it is a bit of a puzzle to me that a country which has such a deep spiritual heritage and wisdom is actually interpreting mindfulness and living in the present in the wrong ways. Living in the present doesn't mean that one doesn't worry about the future, but consume and also pander to instant gratification. Mindfulness and living in the present simply means one does what one has to do in the present, mindful of one's duties and obligations, without necessarily worrying about the consequences and whether the fruits of such actions will materialize or not. Living in the present and mindfulness did not mean that one had zero consideration for the long term. But I'm not saying that Indians are interpreting mindfulness and living in the present in this manner. They may not be. But our actions make me worry that we may be interpreting mindfulness and living in the present as being myopic. SEBI brought out a very good working paper early in 2022, if I'm not mistaken, or 2023, about how 9 in 10 derivative trades lose money. And yet today we are still talking about the kind of volume surge we are seeing in F&O segments. And if we look at the RBI data on public issues and rights issues of equity, even including private placements, in 22-23, we basically had about 2.1 or 2.11 lakh crores of total funds raised for the commercial sector in India, of a total of 29.5 crores, all resources combined, debt, equity, public, private, foreign resources, all put together. The Indian commercial sector, the flow of resources to the Indian commercial sector, including bank credit and foreign resources, was about 29.5 lakh crores in 22-23. Equity alone, public and private placement, constituted only about 2.11 lakh crores. One can think, and of course, I'm not including foreign direct investment, which mostly comes in the form of equity. And if I add that, that number indeed goes up by another 50,000 crores, not a big sum. So 2.6 or 2.7 lakh crores out of 29.5 lakh crores that comes in the form of overall resources to the public, to the commercial sector. I beg your pardon. I think the foreign direct investment translates into a figure of 3.35 lakh crores, or not 50,000 crores. So I'm talking about 5.5 lakh crores out of about 29.5 lakh crores, which probably come in the form of equity. And that is still a ratio of 1:4 or 1:5, if we can very loosely talk in terms of the equity debt mix of all the sources that come to the Indian commercial sector. And this number, from a macroeconomic perspective, is probably on the lower side in terms of the equity debt balance. So what is needed in terms of the mindset is to be able to focus on long-term equity capital formation in the country. And for that, I think it is important, it is not just the regulator, but also the market participants, including investors, realize that the regulator is not somebody who needs to be tolerated, but who is providing the correct counterbalance or corrective to this instant gratification or myopia, which, with few exceptions, is the dominant sentiment, especially during optimistic times. Somebody, basically, even in temple chariot rides, some of you who have seen those festivals, there is always somebody who has to make sure that the flow and the pace of the chariot movement has to be moderated and managed over time if the chariot has to complete its entire journey around the temple. Otherwise, there will be disaster. So right now, what we have, both in terms of mindsets and in terms of public reactions, there is a certain adversarial attitude that we adopt vis-a-vis regulators. Yes, there can always be a dialogue, discussion, differences with respect to specific measures. But the underlying focus that the regulators have which is to ensure that we stay stronger for longer, rather than get caught up in the immediate euphoria of our growth rates and market valuations, and also try to make instant profits. And that is what the rising exposure of even small investors in the F&O segment signal to me, and that is a worry. Because we don't want to go through boom and bust cycles again and again and again. One thing that distinguishes human beings from other living organisms is supposedly our ability to learn and not repeat the same mistake. We can commit new mistakes but not repeat the same ones of the past. And therefore, my submission that conferences of this nature have to focus also on how do we inculcate, or NISM, how do we inculcate capacity building in terms of the mental attitudes that are needed to sustain capital formation. Skill and capacity building have to become broader in definition. Let me turn to one last remark on what else is needed. While I have spoken at length on the mindsets that are needed to sustain capital formation, we should also remember that ultimately our work and our preparations for sustaining capital formation has to be based on empirical analysis. In fact, Table 64 of the Reserve Bank of India's Handbook of Statistics on the Indian Economy is actually giving you very, very important pointers, just so that we don't forget the kind of situation we faced in 2017-18 all the way up to 2021. Take a look at the fact about non-food credit in the Indian banking system. The flow of non-food credit to the commercial sector, to the private commercial sector, or including public, was 11.5 lakh crores in 2018-19. It dropped to 4.7 lakh crores in 2021. So there is a drop of almost 7 lakh crores in the flow of banking, non-food bank credit. Let's take housing finance companies. The flow was 2.2 lakh crores in 2017-18, dropped to 28,500 crores in just 2 years in 19-20. Funding given by systemically important non-deposit taking NBFCs and deposit taking NBFCs, of course net of bank credit which they obtained, was 3.7 lakh crores in 2017-18, dropped to 85,000 crores only. The orders of magnitude of contraction in just a 2-year period in the banking system, in NBFCs, in housing finance companies was so big that naturally the Indian economy, even before COVID set in, was in a weaker state. And why did this happen? This happened because of exuberance in borrowing and lending that prevailed in the first decade, spilling over into the second decade. And this is the kind of memory that we should remember. And in order to ensure that one doesn't overlend or overborrow, because again, remember, in the first decade of the millennium, the bank assets to GDP ratio in India doubled from around 28% at the end of 1999-2000 to more than 56%, double, the ratio doubling in a decade when nominal GDP growth was in double digits, is what paved the way for the rise in non-performing assets and all the hard work that needed to be done in the second decade. If we don't have to repeat such spells of excess lending and then indigestion and rebuilding of balance sheets, we should plan ahead by looking at what is the kind of investment ratio that this country needs for the kind of nominal GDP growth that it will have for the next 20 years. And what is the nominal GDP growth that is possible given our demographics, labor and capital productivity? If this is the investment ratio that we can sustain, what does it mean in terms of actual flow of resources that is needed? How much of it has to come in the form of equity? How much of it has to come in the form of debt, so that the overall macro financial balance does not get jeopardized? If we naturally, much will come in the form of debt. And if such is the amount of debt that is required, and partly from the banking system, partly from the capital markets. What is the amount of bank capital that will be needed given the capital risk-weighted asset ratio? If that is the amount of equity capital that will be needed in the banking system, where is it going to find this capital? Is it going to find this capital from public budgets? If the banking system remains predominantly in government ownership, or if it has to come from the private sector, why is it a taboo to even discuss corporate ownership of banking assets, of banks? The fact that the mere discussion of the idea of corporate ownership or licensing of banks to corporate houses creates such a backlash and a furor is indeed a cause for reflection on the part of corporates too. Apart from being a cause for reflection on the part of critics and commentators and well-wishers of the Indian economy, etc., corporates also have to reflect on why is it that the public reaction to any proposal, any discussion of corporate ownership of banks or licensing of banks to them creates such a furor is also, unfortunately, a reflection on the overall state of corporate governance in the country. And that goes back to the very issues of myopia and short-termism that I spoke about, which is prevalent among investors, money managers, and the overall sense of euphoria that clouds out the considerations of compounding and waiting patiently for time to emerge, returns to emerge. So I think if India has to sustain capital formation, and the way forward for this, therefore, is in all of us realizing that compounding requires patience and time, that living in the present does not equal to myopia, that delayed gratification and not instant gratification on the answers, not just for individuals, investors or non-investors, but also for businesses, financial asset managers and corporate houses. And if India has to sustain the capital formation for the growth aspirations that we have, and therefore if more banks and more equity are needed, and if corporates are not going to be there in the forefront of driving this, then also it is a cause for reflection on the state of corporate governance in the country, which also indeed, unfortunately, is a victim of some of the short-term impulses that we carry in all of us. And therefore, research conferences such as these should not only focus on the market microstructure that impede or facilitate capital formation, but also on these larger behavioral dimensions and also dimensions such as governance and our empirical database planning for equity rising, borrowing and lending, etc. I once again thank you very much for giving me this opportunity. Much as I would have loved to be present there and deliver these remarks, I hope I have given you enough thoughts for reflection, and hopefully these 2 days of deliberations and various technical sessions will leave us all richer, if not financially, but intellectually. Thank you very much. I wish the conference all success.
It gives me immense pleasure to introduce our distinguished guest of honor, Chairperson SEBI, Ms. Madhabi Puri Buch. Ms. Buch assumed office as Chairperson of SEBI with effect from March 2, 2022. She served as a whole-time member SEBI from April 2017 till October 2021, during which she handled various departments of SEBI. Prior to that, she had a career in financial markets and banking of around 3 decades. She served as a consultant to the New Development Bank in Shanghai, head of the Singapore office of the private equity firm Greater Pacific Capital, Managing Director and Executive Officer at ICICI Securities Limited, and Executive Director on the board of ICICI Bank. Ms. Buch also served as a non-executive director on the boards of various companies. So let us have the privilege of listening to the message of Chairperson SEBI.
So I think this says it all. And I always like to emphasize that the reason I'm very fond of this particular slide, I use it all the time, is because somehow this connotes to me the physicality of our nation and the growth of the real economy. You know, there's actual economic activity happening in villages, in factories, in towns, in cities, And this sort of manifests that picture to me in my mind, that where there is growth, there is capital formation. Where there is capital formation, there is growth. So it's a wonderful virtuous cycle, and we are today as a nation in that wonderful place where one is reinforcing the other. Now the question is, page down also not working. Kya kare bhaiya?
You just tell me.
Now that will work. Maybe that's what they did. Oh yeah. Okay. Thank you. So you can leave it now. I think it's good. So I want to focus, a lot more today on a certain group of assets in our country, the REITs, InvITs, and muni bonds. Mr. Bhatia referred to it briefly in his speech. I think that, very often when I speak particularly to youngsters, and it's interesting that they ask me a question, because they say, we want to be where the puck will be, right? They know that their parents and their so-called seniors have been part of a previous revolution. They have taken the benefits of high growth of certain sectors in the previous generation. Now, the youngsters today are interested in what is going to be the high growth area of the future. They want to know where the puck will be so that they position themselves at a time and place where they will have a tailwind to really help them grow as well. So here's my answer to that question. That answer to that question, in my view, is REITs, InvITs, and muni bonds. Now, why is this? Within SEBI, we've done a very simple exercise, sort of like a back-of-the-envelope exercise, where we asked ourselves, how big can this market be? And we reached the conclusion that just as our equity markets today are at roughly one time GDP, right? The entire market cap is about 1 time GDP. We believe that the total value of our REIT, InvIT, and muni bonds ecosystem can be another 1 time GDP. So that is the opportunity for growth which is available to us as a nation. Now, why do we believe this? In a very simple sort of way, the logic is, if you look at all the goods and services that are produced by the corporate sector today, because that is what manifests itself in the form of the GDP-linked market value, right? Now, if you look at that, and you look at, in parallel, what is the value of the entire real estate infrastructure and municipal services that are provided in the country, where is the balance? So, in theory, the value of REITs, InvITs, and muni bonds will far exceed what is today the value of goods and services produced by the corporate sector. Now, in this context, what is it that we as SEBI see as the building blocks? And that's why, again, I love this little slide, because every business, every ecosystem has building blocks, and it's the regulator's job to ensure that those building blocks are in place to facilitate that growth. So what is it that we have put in place? The most important thing we realized is that the strength of our equity markets comes from our retail investors. Not just directly their participation in the stock market and holding shares of companies, but through mutual funds, through insurance, through the pension funds, and so on. Now, what this reflects is really fractional ownership of companies, right? That's what shareholding is. It is fractional ownership of companies. So in the similar manner, fractional ownership of real estate and fractional ownership of infrastructure is where the strength of the country will lie. So what have we done to facilitate this and to put the building blocks in place to facilitate that growth? The first thing is for us as a regulator to get comfort to go to retail investors, for us to go to our parents, to our in-laws, to our uncles, to our aunts, to our nieces and nephews to say, this is a very good product, you should invest in it. We need to have that comfort. So the first thing that we have done is we have ensured that the governance elements of these asset classes and the disclosure elements of these asset classes are now something that gives us the comfort and gives us the confidence to go and tell our retail investors that we are comfortable with the way these things are structured, we are comfortable with the disclosure and the governance norms, you can now, without worrying, you can think about investing in these products. So that is one of the first things that we did over the last couple of years. The second thing that we have done is to bring down the minimum investment size, because naturally these products which were considered sort of high risk, and therefore the minimum entry price was kept high, we have steadily brought it down, and the intention, the commitment to the industry is down the line, we will bring it down even further. So making it very much affordable, as I often like to refer, this is the sachetization of financial products that we need to do. And with a very, very small amount, somebody should be able to go and own a fractional ownership of these assets. The third thing that we have done in this context is to facilitate innovation and to facilitate digitization of this whole ecosystem, using the now, I would say, concept or framework that we have in the country of saying that there is public infrastructure and private innovation. So in the markets, while the infrastructure is not strictly public, for instance, the exchanges form the basic infrastructure, the depositories form the basic infrastructure of our markets, they do perform the role of public infrastructure, even though they are in somewhat private hands in a diverse and diversified manner. So allowing for platforms like the online bond platform, for instance, allowing, now you've recently seen the notification on small and medium REITs, the objective is that we should now facilitate many more smaller and smaller and smaller units of this ownership to be diversely held and democratically held across the country by our citizens. What is true for REITs is also true for InvITs. And we have a lot of belief in the way in which this infrastructure is going to grow in our country, because with every foreign investor that I meet, I find that the interest in our InvIT structures is growing by the day. There used to be trepidation that the way that the banking system, and we've all been bankers, Mr. Bhatia and I often laugh about it, we've burnt our hands ourselves in the infrastructure sector. We know the pitfalls of that, but the way that InvITs have been structured, the way that there are escrowed accounts, the way that there is a ring fencing against bankruptcy, all of those aspects have resulted in a high level of confidence that the investors now show in our InvIT assets. So there is a huge appetite for this. So for all the youngsters who are looking and wondering as to which area of the financial sector they should enter into, wondering where the high growth is going to come from, I can share with you that the level of investor interest, particularly from foreign investors, in the InvIT space is very, very significant. Bonds. This is another one of my favorite pictures, and I was advised in a forum where I recently used this, saying कि हमारा एक उधर एक Indian hero भी होना चाहिए. मैंने कहा ठीक है, अगली बार अक्षय कुमार को वहाँ पे डाल देंगे. So, the time has come. We all know and we're all delighted that now Government of India bonds will be part of the global indices. And that automatically means that a lot of passive investment will come into the country. The reason we are delighted is that once a benchmark and a yield curve has been established for the sovereign debt, then there is a lot of confidence in terms of investing in the corporate debt as well. So we are expecting that on the back of the inclusion of sovereign debt in the global indices, there will be a significant interest in corporate debt. And so it won't be long before we have an Akshay Kumar standing over there. And certainly, I've asked one of my colleagues to say, yaar, kuch AI lagao, aur wahan pe Akshay Kumar ko bithao. Okay? So we are going to do that very soon. But I think the important thing is to take stock of where we are already. This is a very little known fact. But if you look at our bond market, even as it exists today, while the secondary market has relatively very low liquidity because most of the investors are buy and hold kind of investors, the primary market is actually very robust. So what's really happening, we see here, this is a percentage which is reflecting that if the entire corporate sector in India is borrowing 100 rupees from the banking system, How much is it borrowing from the bonds through the markets, through the bond market? So as you can see, it reached a peak of about 68, almost 70%. And there was a reason for that. Chief Economic Advisor also mentioned about how certain credit deposit ratios in the economy were moving. But if you see, and our expectation is that this number around the 60% mark is actually a number that we can expect to be stable. So for every 100 rupees that the banking system gives to the corporate sector, the bond market gives 60 rupees. This is not small. Okay? And we've only just gotten started in terms of retailizing and facilitating a wider and easier spread of bond investments, particularly through the online bond platform which our teams have facilitated. So we expect this growth really to be quite significant. And with the focus that we have on muni bonds, again, this is something that we hope across the country we are seeing more and more traction. Mr. Bhatia is personally leading this charge in favor of facilitating this, and we expect to see a lot of growth. So another area of high growth for the youngsters to focus on. In all of this growth, as has been discussed, the focus of today's conference is sustained capital formation, and we are very clear that we need that capital to come from everywhere. We need the domestic capital, so you have that 500 rupee note there very, very, very closely to be seen. But we need this capital coming from every part of the world because we are a capital deficient nation. For the aspiration of growth that we have, for the capacity of capital that we can actually absorb, we don't have a savings rate that will allow that to happen at this point in time. So we need the foreign capital, and SEBI is committed to making this happen because we see our fundamental role as facilitators of capital formation, and therefore the objective to say that the ecosystem should be such, there should be trust, there should be faith in the ecosystem, and the mechanism should be flexible enough to accommodate the needs of every single investor who wants to come in to provide capital to fuel the growth in the country. And that is what we are all here to talk about. And I'm hoping that the next few days will give us, as was said earlier, some good insights into what we can do to make this the reality that we're all well on the path to. Thank you.
Thank you, ma'am, for such a thought-provoking message today. Now let us have the pleasure of listening to Shri Uday Kotak, who has graciously consented to be the keynote speaker today. Shri Kotak is the founder and director of Kotak Mahindra Bank. He has played an important role in defining and developing India's banking and financial sector over 3 decades. He is currently co-chairman of the Indo-UK Financial Partnership. He is on the International Advisory Board of the Government of Singapore Investment Corporation. He was the president of Confederation of Indian Industry from June 2020 until May 2021. In 2017, a committee on corporate governance constituted by SEBI under the leadership of Mr. Kotak recommended sweeping changes towards more robust and transparent corporate governance. May I invite Mr. Kotak to address the gathering?
SEBI Chairperson, Ms. Madhabi Puri Buch, Mr. Bhatia, Director NISM, and of course, Member SEBI, Mr. Anant Narayan, Mr. Vashne, Ashish Chavan, many members from NISM, NSC, SEBI, and of course, the part of the practitioner fraternity, ladies and gentlemen. It's a very tough act to follow. After the amount of ground which has been covered by Madhabi Puri Buch, Chief Economic Advisor, and Mr. Bhatia on the whole area of the sustained capital formation, I thought I will make my talk a little more personal in terms of the whole history of how I've seen the development of Indian capital markets and how I see the road ahead from here. It takes me back generations, if I can say, back to 1980. I was a student in Jamnalal Bajaj Institute, and there was a professor from Larsen and Toubro, since we are talking about infrastructure, a gentleman called Professor Shivanand Mankekar. And he taught me the basics of corporate finance, medium and long term, and the importance of IRRs, NPVs, discounted cash flows as the basis for taking corporate decisions as also investment decisions. I found after his lectures, he would normally go away and to the Bombay Stock Exchange stock market. In those days, there was no NSE. So, and I was quite intrigued that here is a core corporate finance man, after his lecture, going to the Bombay Stock Exchange, where on his fundamental knowledge, he used to invest in stocks. So once I requested him, sir, can I come with you? So he said, sure. So Bajaj, as you know, is Back Bay Reclamation. So we walked across the Oval Maidan, past the Rajabhai Tower, into the Mumbai Stock Exchange building, which had just opened, the new one, I think, or the old one had just closed and the new one was opening, and went to a stockbroker, and I was fascinated how he was using core finance and investing in capital markets. It's, of course, a well-known fact. He's become a very successful individual investor, and folklore has it around him that very, very strong fundamental basis of investing. But it took me into a journey post my MBA, and not many people know that I actually bought a stock exchange card in my name in 1985 and went into the ring. In those days, the ring was a physical ring, and buy, sell, all those signals which I learnt. And then in that big ring, there was one corner where there was a lot of crowd, but only one market maker, broker. So I asked, because I was learning, कि वो corner में क्या है? So somebody said, वो चोर गली है. So I said, what does that mean? पूरा ring तो बड़ा है, but ये corner चोर गली क्यों है? कि उधर illiquid stocks trade होते हैं और bid offer between 20 and 50%. And of course, the issues of illiquid stocks, lack of floating stocks, even in the technology world, remain. So I'm just trying to say that we may have been 45 years ago, but the issues which challenge markets in those days continue to be some of the issues which we deal with as we deal with the whole area of capital formation. So if I go back to the journey of Indian capital markets, I am actually amazed at the kind of progress we have made. What we are sitting here and seeing compared to those 80s is just mind-blowing. And I have to put it on record. I have to credit various governments across this period. I have to credit the formation of SEBI in 1992 from a point of time when people in the market practitioners used to say that SEBI has no teeth. I'm sure some of them may now be saying, is it too much? I'm not saying that. But that is the journey, friends, of last 40 to 45 years that we have seen the evolution of Indian capital markets. And I have no doubt and hesitation to say that the capital formation in India has a lot to do the development and regulation of capital markets by policymakers and regulators across generations of governments in the last 40 years. So a big round of kudos to the regulatory system and the policymakers. I saw the development of foreign investors in the 90s, till the 90s and even in 2000s. If you talk to most people, investing in markets was considered as a bad word. That's not a place to be. It was always considered to be negative. And if corporate India wanted to raise capital for growth, it was normally foreign portfolio investors in the 90s, and we saw it started with the GDR market. We were exporting our market. We saw the prominence of an unknown exchange in the world called the Luxembourg Stock Exchange become the place where most Indian GDRs were listed, and probably no other company in the world got listed on that exchange, or very few companies on the world got listed on the stock exchange. From there, the evolution of the QIP market, the private placement market, development of the secondary markets, progress on technology, moving away from the traditional Badla system to the new world, and therefore we need to move to a balance between just the survival of the fittest to not moving to a stage where enterprise starts getting affected because of the situation and the policies which we do. And I'm sure regulators, policymakers will be always trying to sustain and struggle through these important differences. And on my last point, as I think about this future, I have no doubt that when we look at India 2047, there is a very strong ability for India to become the top 2 nation. And it is for us here to put the building blocks. I appreciate the number of areas which I think SEBI has made progress, including the whole area of REITs, InvITs, building new platforms, creating opportunity for players with diverse approaches, and keeping in mind that we want a perfect garden in a wild jungle. With that, I'll say thank you very much, and I'm truly honored to be here on this occasion. Thank you.